Hi everyone. When we perform an audit, one of the key things we need to consider as an auditor is whether the financial statement could be materially misstated because of fraud. Here, fraud risk assessment isn't about trying to prove that someone has committed fraud. It is about understanding where fraud could occur, why someone might have the motivation or opportunity to commit it, how it could be carried out, and what impact it could have on the financial statements. And this is where the auditor mindset becomes important. We don't simply ask, is there any fraud risk? We ask, what could be manipulated? How could it be manipulated? And which area in the financial statement would be affected? So when performing our fraud risk assessment, there are several indicators we need to consider. Number one, management incentives and performance target. Let's start with management incentive and performance targets. Suppose management receive a significant bonus if EBITDA reaches 100 million, but the company is currently standing at 97 million. The bonus itself isn't a fraud risk. It is a fraud risk factor because it creates potential pressure or motivation. So we ask, what could management do to increase EBITDA? Could revenue be recognized too early? Could expenses be pushed to next period? Could provision be reduced? Could certain costs be incorrectly capitalized? The key is to move from identifying the pressure to understanding the potential method of manipulation. Point number two, debt and loan covenants. Another common source of pressure is debt. Suppose a company has a loan covenant required to be maintained to a particular debt to EBITDA ratio. If the company is close to breaching that at year end, management may have the incentive to EBITDA looks better or liability looks lower. So we consider areas such as revenue, expenses, provision, debt classification, and accounting estimates. This question is, what could management potentially manipulate to avoid breaching that covenant? Point number three, poor financial performance. We also consider company's financial performance. Is revenue declining? Are margins falling? Is the company reporting significant losses? Is cash flow under pressure? Poor performance does not mean fraud exists, but it can create pressure on management to present better results to the stakeholders. So we consider which financial statement areas could potentially be manipulated to improve the reported results. Point number four, unrealistic targets and forecasts. Another indicator is aggressive or unrealistic budgets. For example, if the business has historically grown by 5%, but management is suddenly forecasting 30% growth rate without considering a clear business reason, we need to understand why. It doesn't prove fraud, but unrealistic targets can create pressure to achieve the results that may not be commercially realistic. This pressure could influence areas such as revenue recognition, provision, and accounting estimates. Point number five, management attitude towards control. Next, we consider tone at the top. Does management respect internal controls? Do they follow approval procedures? Do they regularly override controls? Do they discourage employees from raising concerns? And how do they respond when control deficiencies are identified? A poor control environment can increase the risk for fraud, and that becomes particularly important when we consider management override. Point number six, management override of control. Management override is particularly important because the senior management may have the ability to bypass the otherwise effective controls. If I take an example, management could post unusual manual journals, make unsupported year-end adjustments, override approval procedures, or instruct finance team to record a transaction in a particular way. That's why journal entry testing is one of the most important in our audit responses. We pay particular attention to unusual journals, especially those posted near to year end by the senior management to unusual accounts outside the normal course of business. The objective is not simply to identify the unusual journals. We wanted to understand whether there is any evidence of inappropriate management override or intervention. Point number seven, significant or unusual transaction. We also look for the transactions that are unusual for the business. For example, a large transaction just before the year end, a significant sales to the new customer, a transaction with unusual contractual terms, or a transaction that does not appear to have an obvious commercial purpose. They don't automatically indicate fraud, but they deserve additional scrutiny. Why? Because we want to understand what happened, why did it happen, who was involved, and how was it accounted for. Point number eight, related party transactions. Related party transactions are another important area. Suppose the company has entered into a significant transaction with a business owned by one of its directors. Here, we need to understand who the counterparty is, why the transaction was entered into, whether the terms are commercially reasonable, and whether it has been appropriately accounted for and disclosed. The risks become higher when the transaction is complex and unusual or not conducted in the normal course of business. Point number 9, significant management judgment. Fraud risk can also arise in areas involving significant management judgment. For example, inventory provision, expected credit losses, impairment, fair value, warranty provision, revenue estimates. The more judgment involved, the greater opportunity for management biases. So we could ask, could management use an unreasonable assumptions to achieve the desired financial result? For example, overly optimistic cash flow forecast can be used to avoid recognizing an impairment. This is where professional skepticism becomes particularly important. Point number 10, significant pressure around year-end transactions. Timing is another important indicator. Suppose we have a large number of transactions in the final few days of the financial year. We need to understand why. Are sales being recorded before revenue recognition criteria met? Are expenses being pushed into the next financial year? Are provision being released just before year end? Are unusual journals being recorded to achieve a particular results? Year-end pressure can therefore increase the risk of financial statement manipulation. Point 11, weak segregation of duties. We also consider whether one person has too much control over a transaction. For example, if the same employee can create and supplies, approves the invoice and release the payment, there is an opportunity for inappropriate activities. Weak segregation of duty does not prove that fraud has occurred, but it can make the fraud easier to commit and harder to detect. Point number 12, employee complaints and whistleblower reports. Another important source of information is employee feedback. This could include whistleblower allegations, internal audit findings, employee complaints, or previous investigation. We shouldn't simply ignore an allegation because it hasn't been proven. We need to understand what exactly has been alleged, who is involved, what evidences exist, and does this information changes our fraud risk assessment. Point number 13, management or finance team turnover. Sudden turnover in senior management or in finance team can also be a useful indicator. For example, suppose a CFO has resigned shortly before the year end following disagreement over accounting treatment. That does not prove any fraud, but we would want to understand what happened. Was there any disagreement over the accounting treatment, say for revenue recognition, accounting estimates, provision, or a significant transaction? The important point is, don't ignore unusual circumstances because they don't prove any fraud. They may provide some important information for our risk assessment. Point 14, complex corporate structure and transactions. Finally, complexity itself can create opportunities. For example, complex group structure, offshore entities, multiple special purpose entities, complicated financial arrangements, or transaction involving several related parties. The more complex the structure is, the more difficult it may be to understand the commercial substance of the transactions. So we need to understand who is actually involved and what is the commercial purpose. So to summarize, how do we actually perform the fraud risk assessment? We don't simply ask management, is there any fraud risk we have in the company? Instead, we gather information from multiple sources. We discuss fraud risk with management and those charged with governance. We understand management incentives and pressures. We perform analytical procedures to identify unusual trends and relationships. We review board minutes. We inspect significant contracts and transactions. We consider related parties. We review internal control findings and whistleblower allegations. We analyze journal and transactions. And importantly, we have an audit team discussion about where and how could fraud potentially occur. So these are the points which we have to consider for fraud risk assessment. That's it for this video. Thank you for watching. I'll see you in the next video.